You might think finding the next market darling is about staring at charts until your eyes blur, or maybe just guessing. But what if there was a more systematic, dare I say, mathematical approach? Today, we're diving into the world of stock screeners, the unsung heroes that transform the overwhelming ocean of market data into actionable insights. Prepare to unlock the hidden algorithms that power smart investment decisions. Imagine you're trying to find a specific type of fish in the ocean. You wouldn't just cast a net randomly and hope for the best. Instead, you'd use a net with a specific mesh size, in a particular depth, looking for certain characteristics. A stock screener is precisely that, a sophisticated digital net designed to filter the vast ocean of publicly traded companies based on predefined characteristics. It's about precision, not luck. These characteristics are what we call filters or criteria. They can be anything from a company's revenue growth to its debt-to-equity ratio, or even how its stock price has moved recently. Each filter acts as a mathematical condition that a stock must satisfy to pass through our digital net. The more filters you apply, the more specific your catch becomes, narrowing down thousands of possibilities to a manageable few. The article mentions both fundamental and technical criteria. Think of it this way: fundamental analysis is like checking a company's health report, its balance sheet, income statement, cash flow. It tells you what the company is. Technical analysis, on the other hand, is like monitoring its pulse and temperature, its price movements, trading volume, momentum. It tells you how the market is reacting to the company, often revealing patterns that fundamental data alone might miss. Some screeners even incorporate entire investment philosophies, like Cancelim or Minervini, which are essentially prepackaged sets of highly specific fundamental and technical filters. These aren't just random criteria, they're battle-tested frameworks designed to identify stocks with specific growth potential or market leadership qualities. It's like having a master chef's recipe for finding the perfect ingredient, ensuring consistency and a higher probability of success. But screeners aren't just for individual stocks. The article highlights market breadth indicators. This is crucial, especially on days like today when the VIX, our fear gauge, is spiking and major indices are down. Market breadth tells us if the market's movements are broad-based or driven by just a few stocks. If the index is falling, but only a handful of stocks are responsible, while the majority are holding steady, that's one signal. If the vast majority of stocks are declining, that's a much stronger, more concerning signal about overall market health. Imagine an index is down, but 80% of its components are actually up. That would be a very narrow decline, potentially a buying opportunity for specific sectors. Conversely, if an index is down, and 90% of its components are also down, that suggests a broad-based sell-off, indicating systemic weakness. Screeners, especially those with breadth indicators, help us see this underlying reality, moving beyond the headline numbers to the true participation of the market. So, a stock screener isn't just a fancy search engine, it's a powerful analytical tool that allows investors to systematically apply rigorous criteria, uncover hidden opportunities, and even gauge the overall health of the market. It transforms the art of stock picking into a more scientific, data-driven process, moving us from gut feelings to calculated decisions. It's about building your own digital scout, constantly sifting through the noise to find what truly matters.